I'm Chartered, your accounting tutor. In today's video and class, we are still on end of accounting period adjustment. End of accounting period adjustment. This is the topic from day one. I told you that it is not easy because most learners find it difficult to adjust this, to make this adjustment in financial statements. And that is why I'm taking my time to break the adjustment one after another before a given question will be solved. And today we are looking at sale of non-current assets. Sale of non-current assets during the year. Non-current assets, as you know, they are assets that are acquired or purchased by the business to be used for a long time, at least from 2 years and ahead, for the purpose of generating economic benefit from it. That is, they are used to derive revenue for the business for a period of at least more than 1 year. So at the end of the day, some of these assets, due to one reason or another, they are being sold out. So they are sold out is either the business may gain or loss. So what do we mean by sale of non-current assets? This refers to the sale of non-current assets purchased by the business and we are put to use for a period of time, either 2 or 3 years or even more, as the case may be. As the assets are sold, the business can get a gain or loss from the sale of the assets. As the assets are being sold out, the business will either make gain from that sale or make loss from the sale of the assets. Though the assets were meant not for sale, but as they are being sold out, it's either the business recover money from the sale of the assets and make gain, or the money will lose, as the case may be. Let's look at the situation whereby an asset is being sold and is given as an adjustment. How do you handle such a situation? This is a given trial balance extract, as you know. Taking that a business acquired a motor vehicle for some time and the cost of the motor vehicle was 800,000. And then provision for depreciation of motor vehicle 300,000. If you recall, I have already treated depreciation. And mind you, any depreciation given in the trial balance is referred to as accumulated depreciation. What is called depreciation that have been there for over the years. That is, the assets have been depreciating over the years and the amount have been accumulating for some time. And that is the type of depreciation you see given in the trial balance, not a single year depreciation. And this is the depreciation of the motor vehicle for over time, either 2 to 3 years, depending on when it was purchased. And then the value is 300,000. At the end of a given year, take it out, at the end of 31st 2025, the motor vehicle was now sold. Look at the attachment information. In the attachment information, they are reminding you that the motor vehicle was sold for 520,000 cash. The depreciation of the motor vehicle over time was 5% on cost. So this is the information. So with this, you have to determine whether the motor vehicle is being sold at a gain or at a loss. And mind you, if it is sold at a gain, the gain is added to gross profit. It is treated under other income. Profit on sale of non-current assets is treated under other what? Income, as I explained the other time. If you go to the format of profit or loss, discover that profit on sale of non-current assets is an item under other income, which is added to gross profit. So at this point, we have to determine whether the motor vehicle that was sold at 520,000 is sold at a gain or sold at a loss. Let's look at the workings. Let's go to the workings quickly. Let's now present your working in this way. Sale of motor vehicle. First, you take the cost, the actual cost, what is going accounting, the historical cost, the actual cost that the motor vehicle was having purchased. Then in this case, the cost of the motor vehicle when it was purchased was 800,000. The second, you have to bring the accumulated depreciation. It's clear that the motor vehicle have been accumulating, have been depreciating over time. So you have to get the accumulated depreciation to deduct so that you get what is called the written down value of the motor vehicle. So over the years, the motor vehicle have depreciated, the value was 300,000. So if you minus or deduct 300,000 from 800,000, you get 500,000. But mind you, this was the previous depreciation. Then at the year end, you can see as an adjustment, all adjustment given at the year end means these are things that happen at the end of the accounting period. So it means at the end of 31st 12, 2025, the motor vehicle was sold. So an asset depreciates at the cost of time, and the depreciation is calculated at the end of an accounting period, that is over a period of at least 12 months. So it means that this was the previous depreciation. So as the assets stay in the business from the beginning of January 2025 to the end of 2025, which is December 12th month, the assets will still depreciate. So a year the depreciation was 5% given. So you have to still calculate, and it's straight line method, whereby the depreciation is based on cost of the assets. So you have to calculate the depreciation of the assets in that very year that have been sold, because this one is the previous depreciation that have been accumulated. Then in the current year, then the assets will still depreciate, because depreciation of the asset accounting is every year. So in the current year, you have to still work 5% of the cost and you get 40,000. Then you still have to deduct from the written down value after reducing the accumulated depreciation. Then you get 460,000. Then meaning, as at the time of the sale of the motor vehicle, each written down value, or what you call net book value, is 460,000. So this is the actual value of the assets in accounting perspective that the motor vehicle is having. The value of the motor vehicle is 460,000 as at the time it was sold at the end of the year 2025. Then you now take the sales value of the asset as the time of the sale. We now say sale of motor vehicle. It is clear that the motor vehicle was sold at 520,000. But you cannot just know whether the sale value of 520,000 is gain or loss. You cannot know until you present it the way I'm presenting before you know that it was sold at a profit or loss. So here the sale value of the motor vehicle was 520,000. After reducing the depreciation, both accumulated depreciation and the current year depreciation from the cost of the assets, you discover that the written down value of the assets is 460,000. Then you discover that if the motor vehicle is sold at 520,000 and each written down value is 460,000, if you deduct the 460 from 520, you'll be able to get 60,000. So it is clear that if the sales value in this case is more than the written down value of the assets, the business have made a gain of 60,000 in the sale of the assets. So the reverse is the case, a situation whereby if you deduct the depreciation, the current year depreciation, and you arrive at an amount whereby the sales value is less than the written down value, then you know that the asset is being sold at a loss. So how do you treat it? I explained that the gain on sale of non-current assets is an income to the business. It is an income to the business and is added to gross profit and is treated under other income, under statement of profit or loss. But if it is a loss, for instance, if the reverse the case, if the sale is 460 and the written down value become 520, you discover that the business will make a loss of 60,000 as the case may be. So if it's a loss, the loss will be treated as operating expenses. But in this case, it is a gain, and this gain will be treated as income added to gross profit under other income, under statement of profit or loss. Mind you, this is how sale of non-current assets are treated. The most important thing here is for you to be very careful to know the cost of the assets and know how the assets will depreciate over time. You must take the depreciation serious, because that is what will make you to get it right. Because you must get the written down value of the assets correctly before minusing from the cost to know the value, the written down value, before you subtract the sales value to know whether the assets is being sold at profit or what? Loss. Sometimes you know that we have different methodology. Like here is the cost. Cost means the depreciation of the asset is constant over the year. Like in this case, it means that every year the assets is depreciating 40,000 because 40,000 is constant. That is straight line. Every year the assets will depreciate 40,000. But if it is reducing balance method, then it means that the depreciation will not be equal. So you have to calculate based on reducing balance method when the asset was check. You keep on reducing and calculating it until you arrive at the correct written down value of the assets before you deduct from the sale of the assets to get whether the asset is sold at a profit or what? Loss. That is the most salient aspect in the case of a sale of an asset in the business, sale of non-current assets in the business. Don't forget to follow this video because even now we are still going to show how this will appear in the ledger account so that it will be incorporated in the adjusted trial balance, and I also show you how it will appear and used in the statement of profit or loss and statement of financial position. Don't forget to follow my video, like and comment. If there's any question, share so that the knowledge will grow, and most learners that have difficulties to handle such issues will have no issue in accounting, and we have a very sound foundation that will take them to places. Thank you. I remain Charter, your accounting tutor.